This video is going to cover a few different topics related to risk management that are extremely important regardless of what trading instrument you use. It could be options or it can be shares. Whichever you're trading, it's still a very important variable to any successful trading strategy, and it's often neglected entirely. So this video is going to cover position sizing and progressive exposure, which both require at least a basic understanding if you're going to be pulling profits out of the market consistently. I understand that this video may be a little bit boring. It's not that exciting stuff like technical analysis, entries, exits, stuff along those lines, but there's a lot of value here, so I encourage you to stick through it to the end. Now, for some reason, position sizing really confuses a lot of people. In my view, position sizing is the most important thing that will determine your profit and loss. If you take a bigger position than you should, it could wreck you. And if you take positions that are too small, then your account's not going to move. So this is hands down the most important part of your trading. It's not entries, it's not exits, it's not charts, it's not fundamental analysis, and it's not technical analysis. It's position sizing. And interestingly enough, it's also the least understood. Most new traders, and this included myself when I was a new trader, pay little to no attention to this. Usually you'll find that it's the last chapter in all trading textbooks, and that's if it's even included at all. Because, nowadays most mainstream trading textbooks only cover technical analysis, that exciting stuff. And honestly, if it weren't for me being under the wing of the right people, I may never have had the opportunity to develop an understanding of this importance regarding position sizing, let alone a method to properly do it, which is what we're going to share today. Position sizing can be a bit mathematical, which puts a lot of people off, and people don't really understand how important position sizing is to actually moving your account. Most new traders just don't put the effort into learning this. So in this video, what I'm going to do is try to, make it as simple to understand as possible and give you a very basic, very bare bones overview of how I use position sizing and how you could use progressive exposure to maximize the returns on your account and make sure that the drawdowns are as small as possible. So what I'm going to do is first go through the two rules of position sizing, and then I'm going to apply it to an Excel sheet live to kind of present it to you so you can better understand it and see exactly how it works in action. And if this is confusing, just bear with me for a few minutes until we get to the example, and everything should be crystal clear after that. And if you still have questions after that video on how it works, just shoot me a message on the Discord. This will be very important for the equity alert section of the Discord, and I'll even show you how you could use it with regards to trading options in another video. So before we get to the example, there are two rules that we must always abide by. The first rule is when you start trading an account from a blank slate, it's a fresh account, or it's just your first trade since incorporating this, you always are going to be risking 1% of your total equity. Now, don't let words like equity and total equity scare you. It just means the total number of dollars in your account. So if your account has $5,000, your total equity is just $5,000. That's it. And what you're going to do on your first trade is you're going to risk 1% of this $5,000. Now, I will show you exactly what that means when we do the example in Excel, but for now, just try to remember these rules. If two trades perform well with this amount of risk, then we increase the ROTE, which stands for risk of total equity, to 1.5%. And the same rules apply, again, if two more positions are working at 1.5%, we then increase the risk to 2%. And finally, if two more positions at 2% are working well, then we increase the risk to 2.5%. If this doesn't make sense to you right now, just bear with me. We're going to do that example that is going to show you exactly how we can apply this to your account. Now, if two trades get stopped out consecutively, then meaning you have back-to-back losses, then you reduce your position size to the size below it. So from 2.5%, you get stopped out on two different trades, you come down to 2%. At 2%, you lose on two trades, you come down to 1.5%. And if you lose two more trades at 1.5%, you come down to your initial 1% risk. It's really pretty simple. This is called progressive exposure. And the idea behind it is you want to be positioning more aggressive when you're performing well and the market's working well with your trading strategy, and scaling back when things aren't working quite as well. Every trading strategy is going to have its times of strength and weakness, and you want to be more aggressive during those times where things work for your trading strategy, when you're performing well as a trader, and more cautious when things aren't. Think of it kind of as a dial that you adjust based on your current trading performance. So that's the first rule. Now, the second rule is you always take a maximum of 2 risky positions at a time. So suppose it's the morning and you're finding 10 stocks that are breaking out from your watch list. You're not going to jump into 10 different breakouts at the same time. You're only going to take 2 open positions, 2 risky positions at any given time. Now, what is a risky position? It's one where your stop loss is not at or above your entry price. So say I've entered a stock at $100 and my stop loss is 95. That's a risky position because if the stop loss is hit, I'm going to lose money on that trade. Now say I entered at $100 and that stock started to move up and I move the stop loss up to $100 or 101 or 105. In that case, even if that stop loss is hit now, I'm not going to lose money. So that's considered a safe position. And you could have as many safe positions as you want. In fact, the more the better. But risky positions, we can only have 2 at a time. Now, why do we do this? One is that it caps the intraday loss to 5% on your account. Say you're trading at your full position size, which is 2.5%, and you have 2 risky positions, and the market moves against you and suddenly starts to sell off. For whatever reason, you're going to take a loss of 5% on your account maximum. Now, if you had 10 open positions and they're each at full size at 2.5%, and the market started to reverse on you, that means your account would actually go down 25% in one day, which is a huge no-no. You never, ever want to be in that position. In fact, you should never have a drawdown of more than 5% on your account during any trading day. Now, the other reason why we only have 2 risky positions at a time is if the market is really doing well and you've gotten into 2 breakouts, the odds are at least one of them will work out. If both of them are going to stop you out, then the market is probably telling you it's not yet ripe enough to push higher. You don't have to pile into 10 different breakouts to find out whether they are working or not. 2 breakouts are going to give you enough information on whether the market is constructive and whether or not you could start to take more long positions. So you want to try to curb that FOMO and never get into more than 2 positions per account at any given time. And every time one position becomes free, risk-free, which is when we can move the stop up to the entry price or above that, then you're more than welcome to add another position. And the more free positions we can keep in our account, the better. So just to recap the 2 rules, the first one is we start with a risk of 1%. If 2 of them work, we increase it to 1.5%. If 2 more work, we go up to 2%. And if 2 more work, we put that dial to max, trade at full size at 2.5% risk. And you cap it there. Now, the pilot size is 1%, with the maximum being 2.5%. Say we're at 2.5% risk, and now 2 trades stop out. We're then reducing our risk down to 2%. 2 more fail again. We then reduce that dial down to 1 more notch to 1.5%. And finally, if 2 more stop us out, we're back to trading our pilot size position of 1%. It's very simple. We're just adjusting that dial. This is progressive exposure. You're progressively moving up or you're progressively moving down based on whether your trading strategy is working or not. The second rule was just a max of 2 risky positions at any time, and that's it. These are all the rules that you need to know. So now we're going to move on to the Excel sheet where I'm going to go through a live example of how you could start with any account size and how we could start to determine what the position size for each trade will be. So here's our Excel sheet to show you exactly how I calculate the number of shares I should be buying for any position and how I use progressive exposure to manage my portfolio. So let's say you found a stock that you want to buy. It's Apple. And you have a total equity in your account of $5,000. And this is just the total number of dollars that you could trade within your account. Now, remember that first rule, position sizing and progressive exposure. The first trade, you have a risk of total equity that is 1% of your account. That's what our pilot size is. What that means is we're going to risk $50 in this trade. Now, where did I get that $50 from? It's simply my total equity multiplied by the risk of total equity, which then gives me $50. This is the very simple formula for that. So what this means is, say I'm a breakout trader and I find a bull flag in Apple, and I want to enter it at the breakout. And at the breakout, Apple was $100 a share. I then put my stop loss at the low of day, which happens to be $95. If my stop loss is hit, then I'm going to lose $50. That is the amount that I've risked in that trade. Now, once I know at what price I want to buy a trade and what price I want to put my stop loss at, it's very easy for me to calculate the number of shares. This sheet does it all for you. We're simply going to use this formula, which for those that are curious, is your total equity multiplied by the risk of total equity. And that gave us $50 in this case. And then we're dividing it by your entry price minus your stop loss price. Once again, you don't need to know, what is really happening there. It's for those that are curious how that formula works. And if you would like to use this spreadsheet, I'm going to share it in the Discord. But it really is just simple, basic arithmetic. You're seeing the number of dollars that you're risking, and you're dividing them by the spread between the entry and the stop loss. So your risk of 50 divided by the $5 you're risking between the entry price and the stop tells you that you should only be buying 10 shares. Because if those 10 shares get stopped out, you're going to be losing that $50. So I'm going to go ahead in my brokerage account now, put in an order of 10 shares in Apple. And for the purposes of this example, let's assume the trade works. Apple goes up another 2-3 days, it reaches 110, and I want to book profits there. So I exit at 110, which then gives me a profit of $100 on the trade. So it's super simple, basic arithmetic. Now, once I've made this profit of $100, it gets added to my brokerage account. And so my total equity would now be $5,000 plus $100. So the next day, I come in, I now have $5,100 in my account, and I find DraftKings. I find a similar bull flag setting up on it, and I decide, okay, I want to take another long trade, but in DraftKings. Now, remember, we need 2 profitable trades at 1% before we can increase our risk. So for my second trade, I'm going to continue trading at 1% risk, which means I'm going to continue risking $50. And let's assume DraftKings has a similar chart where it breaks out at $100. I enter, I put the stop loss at the low of day, 95. That makes me buy 10 shares of DraftKings, and then DraftKings goes up another 2 or 3 days. I sell at 110, and I make a profit of $102. Now, why is it $102 and not $100? That's because our total equity in this case was higher from $5,000. We moved on to $5,100. So the P&L is slightly higher too. But now, at the end of the day, our new total equity is $5,202. How do we get that? We made $100 from Apple, and we made $102 from DraftKings. So we've had 2 profitable trades now at a risk of 1%. So our total equity is now $5,202. We come into the next day. This is my new total equity. I like how my positions are working. We've had 2 profitable positions at 1% risk. I find Microsoft forming a bull flag again, and that one is breaking out as well. So I decide I want to buy some Microsoft. Now, will I continue to trade at that 1% risk? No. We've already had 2 profitable trades with this risk, so we're ready to increase the position size up to 1.5%. And that is simply from the rule that we discussed before, which is once you have 2 positions that do well, you then increase the risk to 1.5%. If I'm risking 1.5% on the Microsoft trade, that means the dollar amount that I'm risking is $78 to be exact. Now, let us think about it this way. Microsoft could either work or it could not work. So let's see the worst case example, which is that Microsoft doesn't work. I enter again at $100, putting my stop at 95. I'm now buying 16 shares of Microsoft because, remember, I'm risking more on this trade, so my position size is increased. I buy 16 shares of Microsoft, and my stop loss is hit. So I'm exiting at $95. And what I lose on this trade is $78. After losing that $78, my new account total is at $5,124. So this total is still higher than my original equity, which was $5,000. So the reason we were able to risk more on this trade in the first place was because even if our stop loss was hit on the trade and we were to lose that full 78, our equity curve is not going to dip below what we had originally put into the account. And that's the main goal of using progressive exposure. We keep those drawdowns as controlled and small as possible. So now we've simply come down from 5,200 to 5,124, but we're still above that original $5,000. Now, let's say the next day we come into the trading day and I find another stock and it's Palantir. It's making another bull flag. And because we've only hit one stop loss on 1.5% risk, we can take another trade at this same risk level. We try our luck with Palantir. So again, we're just going to assume Palantir is making that bull flag. It breaks at a $100 level, and the low of day is 95. We put the stop there. We are allowed to buy 15 shares of Palantir. And in this case, let's just see what happens when it works and when it doesn't work. So first, let's assume it does continue breaking out and it goes up to $110. In that case, we've made a profit of $154 in this trade. So our new equity is now this 5,124 plus 154, which is 5,278. That takes our equity to a new high. So we're now comfortably up in our account with a cushion of around $278. But suppose Palantir didn't work. We would have come down another $77 and back to $5,047. We'd still be up on the account by $47. And the goal is to make sure we're not dipping too much below our starting equity that we originally put into the account. And that's the whole idea behind this. Now, remember, because we've lost 2 trades straight, we need to dial our risk down 1 notch. So if we have 2 winning trades, we can increase that risk. But obviously, if 2 losing trades consecutively, same thing for winning trades. 2 consecutive wins, we go up a notch. 2 consecutive losses, we go down. So in the case that we were to trade, Meta for our next trade, then we would only be risking 1% since we had to reduce our exposure due to our losing streak. Now, in the case that Palantir did work and we were comfortably up $5,278, then in my next trade, I'll continue risking 1.5% because to increase their size from 1.5% to 2%, we need 2 consecutive winning trades. And that keyword is consecutive. In this case, we had 1 losing trade and 1 winning trade. So we need 2 consecutive winning trades to be able to increase that size. So here, I take a new trade. It's Google. We risk another 1.5%, which is $79. And Google is once again in that sacred bull flag. We're entering at the breakout level of 100. Putting the stop loss at the low of day, which is 95. Buying 16 shares of Google, and let's assume this one works out well. So it goes up to 3 days, and we decide to take profits at $110. That means I've made another $158 on this trade, and my new equity is now $5,436. So because 2 consecutive trades have now worked at 1.5% and made me profits, I can dial up my risk another notch on my next trade, bringing it from 1.5 up to 2%. So my next trade, I'm allowed to risk 2%. So let's say I find another stock. I'm just going to assume, Mara. I'm risking 2%. And now the dollar amount of risk that I'm taking on this trade is $109. Now, at this point, with the interest of saving time, I don't want to go through the whole example. I don't want to keep doing the whole entry and exit. What I want you to understand is the importance of this number and this number. Risk in total equity. So I now have an equity of $5,436. I'm risking on this trade $109. And my goal is to never dip too much below our starting equity and to never take a big dip in the equity curve. And it's virtually impossible to blow up your account when using progressive exposure and properly positioned sizing. So if I were to lose this trade, I'm going to lose $109. And that's going to bring my equity down to $5,327, which is still going to be above the amount that I originally put into the account. That's the reason that I'm allowing myself to take larger positions in the first place. we're getting traction with our trades. Say we take another trade. This time I take BTC, and this one's also a loser. I'm now back down to 5,221, which is close to where I started from, but still in the green, and I haven't taken too much of a drawdown in my equity curve. In fact, you're still up almost 5% overall. Now, my subsequent trades would be at the risk of 1.5% because I've now taken 2 consecutive losers while at that 2% risk. So we dial it down one notch. You always have to remember that rule. Say if both Mara and Bitcoin had been winners, we would then be up $880 on our account, and we would be able to move the risk up to our maximum of 2.5%. And that would then be allowing us to risk $147 on our next trade. And I'm sure by now you've picked up on how this operates. So hopefully this gives you a sense of why we're reducing and increasing position sizes from 1% to 1.5 to 2% and then eventually to our cap at 2.5%. And why every time we take losses, we have to scale back down. You want to think of your equity curve as a bull flag. So you always want to be making new highs in your equity curve, and the pullbacks or drawdowns, which are perfectly normal and you're going to see in the equity curve, you want to keep as shallow as possible. It's kind of like the pullback buys that we target. We like those more shallow flags rather than a deeper corrective flags. And whatever is the original amount that you start from, like in this example of 5,000, you want to try as much as possible not to lose too much. So hopefully this video gave you a little bit more clarity on what position sizing is, how I use progressive exposure, and why it's so important, and how it can help keep your drawdowns extremely low and controlled. And also showed that you can in fact make good money trading shares solely even with a smaller account. You know, even if we use an account half the size of this one, which would have been $2,500, we would still be up $450 in this example. Now, obviously, you're not going to have big win streaks of this all the time, but you're going to have those win streaks. And when you have those win streaks, that's where you're going to make a lot of money. So trading shares is definitely the way to go, and I highly recommend that you at least give them a shot. I'll make a separate video on position sizing with regards to options in the coming weeks. And if there's any particular thing that I missed out on or that needs a bit more clarity, please let me know. I'll do my best to answer those questions and perhaps make a follow-up video to answer all those. Something that's important to note is if you have a large account, let's say it's 10,000 plus, your initial risk is you're going to want it to be less, like 0.5%, and then dial it up to 1, 1.5, and then 2%. The larger your account, the less that initial risk is going to be, that position, that pilot size. So for my account, I'm literally using 0.12% as my initial risk. So if you have any questions regarding that, DM me so we can customize this to your portfolio size. Smaller accounts are generally going to take larger risk. When I started with trading shares with a $5,000 account, I started with the exact risk amount that I'm shared in this video today. So I would recommend watching this video a couple times to really get a hang of it. It may take some time to grasp, but it's absolutely worth the effort. And not to be dramatic, but understanding of position sizing and progressive exposure is truly what separates the 99% who fail from the one who succeed.